The reserve was 24 to 36 months. That was the prior guidance, and at the time it was 18 months. So it had fallen somewhat below the prior guidance. My view was, is there updated guidance for what the reserve is going to be going forward? And then kind of in the recent weeks, they got as low as 6 months of reserves. It's always easy to kind of be an armchair analyst on these things, but from an investor perspective, you generally do want to see company give a guidance and then kind of generally stick to what they guided that they're going to do. With generally from an investor perspective, you don't want to see surprises. I mean, it's nice to see upside surprises, but you generally don't want to see downside surprises. And so they got very low on reserves. Obviously, we had a Bitcoin bear market, and people did apparently build a lot of leverage on top of STRC. So they ran into a pretty big volatility event.
There are moments when a bull market doesn't break because Bitcoin fails. It breaks because confidence does. The fastest way to expose weakness isn't always a falling price, it's watching what happens when highly leveraged structures suddenly collide with volatility. And after one of the most controversial episodes in strategy's history, even some of Bitcoin's strongest supporters have started asking uncomfortable questions. This isn't another attack on Michael Saylor or a declaration that Bitcoin treasury companies are doomed. It's something much more valuable. Lyn Alden, one of the most respected macro analysts in the industry, takes a step back from the emotion and examines where strategy got into trouble, why its preferred securities came under pressure, and what investors should actually be paying attention to. Her focus isn't on headlines, it's on risk management, reserves, leverage, and whether management delivered what investors were promised. What makes this conversation especially important is that Alden isn't joining either extreme. She's neither celebrating every move strategy makes nor predicting its collapse. Instead, she explains why falling reserve levels became a genuine concern during Bitcoin's bear market, why leverage built on top of STRC amplified the problem, and why maintaining investor confidence often depends less on perfect execution than on keeping your word. In a market already struggling with uncertainty, those distinctions matter more than ever. So in today's video, you'll hear why Lyn Alden believes strategy made several smart decisions, where she thinks management stumbled, how the company responded after the volatility, why she still believes Bitcoin treasury companies have an important role to play, and why self-custody remains the gold standard despite growing institutional adoption. If you enjoy balanced Bitcoin analysis instead of emotional narratives, make sure to like this video, subscribe to the channel, turn on post notifications so you never miss an update. Now, let's hear what Lyn Alden had to say.
What's your big picture when it comes to strategy and stretch?
Sure. So I've been following that company since August 2020 when they announced their Bitcoin strategy. And when I've been on two of their earnings calls. One was back in, I think it was autumn of 2025. And my question there, I generally know that people that go on the calls are on average going to be pretty bullish. And so the way I try to be helpful is often to ask a critical question for a company that otherwise, want to do well. And so back then, it was near all-time highs. And so my question is mainly about bear market stress testing, kind of like how banks, like the Fed, puts banks through a stress test, and kind of models an adverse scenario and sees how the banks are expected to hold up to try to avoid, what happened during the global financial crisis, for example. And so my view was, when times are good at the company, what kind of downside scenario are they making sure that their capital structure is able to withstand? So that was kind of my first kind of somewhat bearish question. Then when I came on, it was like 6 months later, like basically I skipped one earnings and I was on the one after that. That was in February. And at that point, Stretch was doing very well in terms of market size. I work in the venture space in Bitcoin, and I had seen just kind of coming across my desk, some companies looking to build on top of Stretch. Say, they want to use Stretch as an asset they can build other products on. Which, it's just like, well, what if Stretch depegs? I mean, nothing holds it fixed to, its target range. It can always move around. So a combination of knowing that obviously TradFi leverage can build on it, something like a carry trade. If someone sees a low double-digit yield and they can borrow for less than that, they can lever up and buy that, which obviously adds risk to the trade, but then also potentially creates forced selling should that asset start to depeg. combined with the potential of an early stage of other products built on top of it. So my questions was around kind of reestablishing their guidance for their USD reserve, and seeing if they're monitoring this type of leverage building on top of it. And there are risks if they, if a company kind of makes a product sound like it doesn't have any downside risk, and if it's much higher yielding than things like treasuries or the margin rates that people can get, it does kind of encourage leverage on top of it. That was just kind of the concerns I was monitoring for what is otherwise a pretty interesting structure.
Do you feel like they downplayed the risk?
There were some statements like we take away the downside risk, or I don't want to quote them. I don't want to incorrectly quote them. I do think that on average you want to be conservative with how you market a product like this. But I believe others to kind of point out that aspect. But I do think they have to be careful around how they market the product. And I would push back a little bit on social media, because I would see not strategy, but other people would say, why wouldn't you take out as much? Why wouldn't you borrow a ton of money and buy this? And I'm like, well, because there is tail risk. I mean, the dividend is not super. It's got a big reserve backing it, but it's not inherently guaranteed if Bitcoin has crazy price action. In addition, it can depeg, and so especially if you have callable debt, you have to be very careful. When it was announced on the first earnings call that I was on, and I came out and said, I think this is gonna be successful in the market, and it did become the biggest preferred ever done. Mm-hmm. It's the biggest preferred security in the market. But then, after it's out a while, it's like, okay, well, let's make sure that this is stable and that it's kind of backed up. For the earnings call that came after that, I wasn't on that one, but when they were gathering questions, I did post and say, the reserve was 24 to 36 months. That was the prior guidance, and at the time it was 18 months. So it had fallen somewhat below the prior guidance. My view was, is there updated guidance for what the reserve is going to be going forward? And then kind of in the recent weeks, they got as low as 6 months of reserves. So I'd say that that it's always easy to kind of be an armchair analyst on these things. Mm-hmm. But from an investor perspective, you generally do want to see company give a guidance and then kind of generally stick to what they guided that they're going to do. Generally from an investor perspective, you don't want to see surprises. I mean, it's nice to see upside surprises, but you generally don't want to see downside surprises. And so they got very low on reserves. Obviously we had a Bitcoin bear market, and people did apparently build a lot of leverage on top of STRC. So they ran into a pretty big volatility event. I think the actions since then have been quite reasonable. So they've recommitted to building their reserve. They put kind of board level lines in the sand for how low that reserve can get without board approval. I think it's 12 months. And they're currently back up to 17 months of actual reserves, but that kind of board level, I think, is 12 months off the top of my head. They've put in facilities that allow for the repurchase of their securities if they perceive them to be trading at a level that is accretive to the company to buy, which I think makes sense. So I think a combination of just maintaining substantial reserves, kind of keeping within guidance, and being willing to take advantage of arbitrage opportunities if they come along, is about the best the company can do. And everything after that really comes down to Bitcoin price action. Obviously, if you're a levered entity on Bitcoin or gold or whatever the asset might be, if that asset falls, generally speaking, a levered entity is going to be in for a rougher time. And if that asset goes up considerably, that asset's often going to outperform. So I think that they've taken actions that I think are very reasonable. With the criticism that it would have been nice to just not have the reserve fall so far out of the prior guidance, but once the market sent them that signal, I think that they did act very quickly to it.
Lyn Alden's biggest criticism wasn't that strategy used leverage, it was that investors deserve consistency. In her view, leverage can create enormous value when it's paired with conservative risk management, transparent communication, and reserve levels that match management's own guidance. Once those reserves fell well below expectations during the Bitcoin downturn, the market delivered a harsh reminder that even the strongest balance sheet can lose credibility if investors begin questioning its resilience. At the same time, she gives strategy credit for reacting quickly, rebuilding reserves, strengthening internal safeguards, and taking practical steps to restore confidence after the worst of the volatility had passed. But the discussion doesn't stop with one company. It expands into a much bigger question facing Bitcoin itself. As corporations, ETFs, retirement accounts, and even governments continue entering the market, what role should Bitcoin treasury companies actually play? Are they accelerating global adoption, or are they slowly replacing direct ownership with layers of financial products? That's where Lyn Alden offers perhaps her most important perspective of the entire interview.
How do you see this whole asset class and the reaction of the market to it?
I mean, so I think there's a spectrum here. I would first say that I think the best Bitcoin is self-custodial Bitcoin, just like the best gold is self-custodial gold, not like a gold ETF or anything like that. So it's, when you have relatively few assets that are liquid and you can self-custody, often the best way is to actually use it for that purpose. You basically do what you can't do with stocks and things like that. And so I think, that's the first thing. The second thing where I do push back against some of people that are super critical on any corporation owning it is that there's no world where Bitcoin becomes a multi-trillion-dollar liquid asset that is somehow magically only owned by like retail investors. Any sort of large pool of capital, if they get bullish on the asset at a CEO or a board level, it makes sense for them to want to have some of that asset as well and benefit their shareholders or whatever they might be doing, whether it's a corporation, an insurance company, a sovereign wealth fund, a central bank, whatever the case may be. If they get bowled up on Bitcoin and it's liquid and large enough that an entity of their size can actually take it seriously, which they couldn't do in 2013, right? It's just too small and too illiquid for a large pool of capital to get involved. But now that Bitcoin's pretty big, it makes sense for some of them to want to get involved, and I think that's rational. And then I think from there, it comes down to specifics. If someone says you shouldn't own Bitcoin, you should only own, Bitcoin proxies, I would generally push back on that unless someone is, saying, hey, if you only have a retirement account, at least, if you're bullish on Bitcoin, at least there's products for you now, right? But I would generally push back on people trying to get people to not hold actual Bitcoin and get into these securities. But that's not what a lot of them are doing. I mean, you can pull out individual remarks. I'm not going to say what every person out there has said, but there are kind of walled garden pools of capital, retirement accounts, things like that. There are pools of capital that have mandates. They have to own bonds or they have to own certain types of securities, and these make them. If you happen to be a Bitcoiner in a seat that has to run that type of capital, then you have Bitcoin securities. You can potentially do Bitcoin miners. You can do Bitcoin treasury companies. That there are these avenues available. So I think that there's a spectrum. If someone's bullish on levered Bitcoin, like if they're bullish on Bitcoin and they want leverage attached to it that's not callable, the treasury companies are able to provide that. They can generally structure their leverage different than you would at like a margin on an exchange. Or time sensitive option of some sort, like a derivative. So I think there's a market for it. I'd only get concerned really when it's being marketed that you shouldn't buy Bitcoin, you should only buy the securities, or if any way those securities are kind of like marketed incorrectly. There are also times where a company might get too leveraged, and I'd be concerned. But I think that whenever something's doing bad in price action, there's going to be more pushback, and whenever something is doing really well in price action, there's kind of hero worship. So I think that both in the upside and downside, these things tend to get amplified. Whereas the truth of it is, in this case, a company bought, a little over 4% of Bitcoin, and they levered it, and it's going to depend on how well they execute.
But ultimately, if Bitcoin is going to do what we think it's going to do, a lot of these companies are going to do well, right?
Yeah, as long as they manage their liabilities. There's a path dependence here. If you can lever something and still blow up when it goes up, if you get shaken out at the bottom too hard. So if a company is somewhat counter-cyclical in its thinking and is able to get leverage, benefit from the upside, manage the downside risk, and if the asset goes up, then they and their shareholders should do well. The other caveat there is not buying at very, very high MNAVs. Mm-hmm. Some of these are trading at exceptionally high MNAVs. So buying on the low to mid side of that where possible is the other option. I think, I mean, one of the disappointing things this past cycle is that there really wasn't a lot of new retail demand for kind of Bitcoin, the asset. When you look at just on-chain addresses that hold a small but non-trivial amount of Bitcoin, so not like dust and just kind of one-time use addresses, but like basically like just chunks of Bitcoin getting off exchanges and kind of sitting in what is presumably cold storage, not as high as I'd like to see. And I think some of the critics would say, well, like this, I mean, basically this has been the corporate cycle. So a lot of the new capital that came in was corporate. And that's where I think the bulls and the bears would differ, because some people would say, well, if we didn't have the corporate adoption, we wouldn't have had almost anyone coming into Bitcoin this cycle. Whereas the other ones would say, well, if we didn't have the corporate adoption, maybe more of those would have come into actual Bitcoin. And I think, counterfactuals are always hard to say. But I do think that as Bitcoin gets bigger and more liquid, it's going to, to the extent that that keeps happening, it's going to appeal to more types of pools of capital. So in the early stage, it could only really be used by individuals. But once it got large enough, it can be used by entities of various types. And, there was this kind of underserved market for a long time. I mean, but you didn't have Bitcoin ETFs weren't allowed. GBTC had its own, it was traded over the counter. It fluctuated in terms of premium or discount to the underlying Bitcoin. And so there's a ton of capital held, managed by RIAs or in retirement accounts that just for years couldn't access Bitcoin. Mm-hmm. So it makes sense that this cycle is how they start coming in. They get in with either some of the securities that are out there or some of the ETFs that are out there. So that's kind of like a pent-up demand, I think, entering it. I wouldn't want to see that as like every cycle where it's always these Bitcoin proxies that are gaining a lot of it. But yeah, I think that as a liquid asset, it's going to be to the extent that it's successful, it's going to be held by all different types of entities. So I think the kind of the best we as like Bitcoin enthusiasts can do, and this is why I work in venture for the space, is to keep trying to fund solutions that we believe are going to be successful in making people able to use Bitcoin directly. Payment companies, wallet companies, all these brokerages that let people buy Bitcoin and take self-custody of it. And so I think it's important, or privacy solutions, for example. I think all of those are extremely important. But then alongside that, there is going to be, again, assuming it continues to be successful, there is going to be corporate adoption, some degree of sovereign adoption, and just other types of balance sheets that want to either arbitrage it or just hold it for their stakeholders.
One of the biggest takeaways from this conversation is that Lyn Alden refuses to reduce a complex issue into simple talking points. She acknowledges that Bitcoin treasury companies serve a real purpose by opening the asset to pools of capital that simply cannot own Bitcoin directly. At the same time, she warns investors against forgetting the difference between owning Bitcoin itself and owning a leveraged company whose success depends on management decisions, debt structures, and disciplined execution. Her message is equally important for Bitcoin's future. If Bitcoin continues evolving into a global reserve asset worth many trillions of dollars, it won't be owned exclusively by retail investors. Corporations, pension funds, sovereign wealth funds, insurance companies, and eventually governments will all want exposure. That evolution is both inevitable and rational. But none of it changes what Alden considers the strongest form of ownership, self-custodied Bitcoin that sits outside anyone else's balance sheet. Perhaps the most surprising part of her analysis is her reminder that even during this cycle, retail participation has remained weaker than many expected. Corporate buyers have dominated much of the new demand, creating an ongoing debate over whether institutions are accelerating Bitcoin adoption or simply replacing organic retail growth. It's a question without an easy answer, but it's one every investor should be thinking about as Bitcoin matures. In the end, Lyn Alden leaves us with a balanced framework rather than a prediction. Leverage isn't automatically dangerous, and corporate adoption isn't automatically bullish or bearish. Success depends on responsible management, transparent communication, disciplined reserves. And above all, Bitcoin continuing to appreciate over the long term. That's the nuance often missing from today's debates, and perhaps the most valuable lesson from this entire discussion. If you enjoyed this breakdown, don't forget to leave a like, subscribe to the channel, and turn on post notifications so you never miss our latest Bitcoin and macro analysis. Thanks so much for watching, and we'll see you in the next video.